This is Optionality-Pro session 5 of 6. Now, it's called Intro to Options. However, you're going to think, yeah, but this is the fifth of 6 sessions, and this is only an intro. Well, that's because, like I've been saying, 95% of your trading has to do with selecting stocks. And that's why the first 4 sessions were stock trading. Because when you trade an option, you're really trading a stock. The option is just a vehicle. So 95% is knowing how to pick a good stock. The other 5% is knowing a little bit about options, which is what this session will cover. Now, this material was presented before quite a while ago, so a lot of you might have seen all this material, but some of you haven't, so we have to go through it again. All right. Now, one quick note to you is I'm not going to answer questions unless they're really pertinent and compelling until the end of the session, so just so you know. Anyhow, option basics. An option is essentially the right to buy. You're purchasing the right to buy somebody else's shares of stock. Now, remember, it's only a right. It doesn't mean you're ever going to buy them. It just means you pay a little extra premium to reserve the right to buy shares at a certain price, and there's a time period attached to that contract. Let's say it's for 10 days, just let's say. By the time that 10 days expires, either you buy the shares at the agreed upon price, or your option contract is void and you're done. For example, if you're a shareholder and you own 100 shares of Microsoft, let's say it's trading at $27.50, you could set up an option contract with somebody else. It gives them the right to buy 100 Microsoft shares at $27.50. This expires in 15 days, let's say. Now, what that means is, that means any time during that 15 days, or at the end of the 15 days, you could buy Microsoft at $27.50 from this guy, and it doesn't matter what the price is. The price could be $50. You can still buy it at $27.50. Now, to get that right, you pay a premium. And in this example, let's say that premium is 50 cents per share. So the options contract is agreed upon, and you give this guy 50 cents per share. So he makes $50 no matter what happens. That 50 is gone. It's in the shareholder's hands, and you're done with that transaction. And then the option contract is good until the expiration date. Now, the options contract is $50. That's how much it cost you. Here's the deal, though. Option contracts can be traded back and forth between holders like stocks. You see that? So here's the thing. They go up and down in value as the underlying stock moves. And therein is the key. That's how and why you can trade options as opposed to stock. But note that there's an underlying stock. So for you to pick up an options contract on Microsoft, as in my example, you'd obviously have to believe that Microsoft is going up. Because where it gets interesting is that if Microsoft starts at $27.50 and you pay, let's say, 50 cents per share for the right to buy Microsoft at $27.50, if Microsoft goes to, say, $28.50, it gains $1. Theoretically, your option value now moves up about $1. It's $1 above what we call the strike price. The strike price is $27.50. So now the option contract has gained 200% in value. Now you're thinking, what? Well, look what just happened here. Okay. If the option contract costed you $50, let me get a pen here. If it cost you $50 and it goes up $1 per share contract-wise, that contract is now worth $150. That's a gain of $100, which is a 200% gain on that quote-unquote investment. You see that? Now that is absolutely fantastic. You know, because a lot of people are buying, you know, a lot of people like to trade in penny stocks which are super risky and very volatile, and you don't know what's going to happen. Hoping for big gains like this, but which you rarely get. But with options, you're trading a quote-unquote 50 cents a share to make these magnificent gains. And this is what is so attractive about options. So the cost is 50. It is now worth 150 because Microsoft went up. Your gain is 200%. Pretty phenomenal. Now, this is only approximate, but it can go something like this. Now, if you bought the straight shares, your cost for $100 would be $27.50. This is instead of doing options. Let's say you just bought 100 shares of Microsoft. If it went up $1, your current position is now worth $2,850. You've still gained $100, just like you did in the options, but your gain is only 3.6%. So you can see there's a huge difference percentage-wise. So, putting all else aside, all other factors equal, which would you rather do? $50 or $2,750 to make $100? You see why this is so attractive, especially with small accounts. So for pennies on the dollar, you can trade big stocks. And that is the attraction of options. It's ideal for small accounts. Let's say you only got $2,000 to do stocks with. I can tell you right now, it is almost impossible to make gains worthwhile, worth your time on straight stock if all you have is $2,000. It's almost impossible. Because just to overcome commissions, you have to make unbelievable gains. But a $2,000 options account is totally suitable to make steady, nice gains, provided all the other stuff is in, like I've described in the past sessions, your discipline and et cetera. Now, it's ideal for small accounts, which of course is most people on the planet. I mean, how many people realistically have, a $200,000 trading account? So that's why we're pushing this hard, because it's really good for the common person. Now, put options, real quickly. A put option, what I just described before, is called a call option. A call option, like I said, gives you the right to buy shares at a certain price. A put option, however, gives you the right to sell shares at a certain price. In essence, it gives you the right to sell short. Now, on the call option, as the underlying stock moves up, your option goes up in value. Your option contract increases in value. On a put option, however, as the stock falls, your option goes up in value. A lot of people are afraid of put options. It's just psychological. I mean, for example, yesterday, put options were wonderful. Yesterday's market, because the Dow fell 300 points. If you weren't in put options, you were crazy, because there were some nice windfalls to be made on put options. So it's ideal for when the market is crashing, because your portfolio can explode in value if you know the right put options to trade. And we saw that eyewitness yesterday. Those of you who follow Gar's Gold. I personally only made a little bit because I didn't do a lot of trades. But man, some of those choices were just, 100%, 150%, while everyone is screaming and yelling, losing their ass on stocks, unless they were short. So it's very interesting. Two key points before I go on. You trade options just like stocks as they go up and down in value. All right, you will never exercise the option. I mean, unless you want to, but I don't see why you would. So remember, you buy a contract. It is the right to buy, but not the obligation. So you just buy these contracts, then you sell them, for a gain or loss, whatever. You don't ever exercise. You don't ever buy the underlying stock. You leave that to somebody else at the end of the contract. Options represent underlying stock. A good option trade occurs when you correctly assess the movement of the underlying stock. I don't know how many times I've had to answer the question, Gar, I'd like to do options, but I don't know how. I don't know what I'm supposed to look for. And this comes from somebody who's traded stocks for 5 years. And I'm thinking, what? No, there's no difference. Well, there are some differences, which I'm going to show you tonight, but you're doing the same thing. You're picking stocks, and the option is just a way to trade the stock with pennies to the dollar. So important definitions before I go on. This is especially important for new people. A lot of you guys already know these, but these are some key definition of terms in the option world. A contract. It's when you buy options, you buy contracts. You don't buy individual options. A contract is 100 options. It's the right, but not the obligation, to buy the underlying stock at a specific price for a specific period of time. That's for a call option. On a put option, same thing, except it's the right to sell a stock at a specific price for a certain period of time. Put options go in verse of call options against the underlying stock. Otherwise, they're identical. It's just a contract you buy, whether it's put or call. Premium. The premium is the price you pay per share for the right to buy, or sell, I should have put. Also referred to as the time value of an option. The premium value depends on the time to expiration and the price of the underlying stock. So if you buy an option that expires in 3 months, you're going to pay a really high premium. If you buy an option contract that expires in 2 days, you're going to pay almost no premium. You see how that works? So it's time sensitive. Strike price. The strike price is the price you have the right to buy or sell the underlying stock. So in the example I gave you, $27.50 was the strike price for Microsoft. In the money. That's not the song, we're in the money. That's not what that means. Although it could if you do have a good trade. In the money means it's when the underlying stock is equal to or above the strike price. In the case of a put option, it would be equal to or below the strike price. For example, strike price is $20. If the stock is $20.50, it is in the money. That's very important to remember, because it's only when the stock is in the money does it really skyrocket in value if the stock keeps going higher. Intrinsic value. The intrinsic value is the difference between the strike price and underlying stock price. Intrinsic value means how much the stock is in the money. It's just a term you have to, in case you hear it. Now, here's the deal. The value of any option, in other words, the quoted price, generally speaking, at any given time, is the premium plus intrinsic value. Now, this all seems complicated. However, you don't generally need to calculate these numbers. They are automatically computed in the quote, in this option quote. In the previous example, $25 strike options for Microsoft would quote, let's say, $4.50. In other words, I'm just giving you these terms in case you hear them thrown at you. You don't need to write these down and memorize all this, or you don't even need to understand it fully. You just need to know what's going on behind the scene. But when you trade the option, you're just going to see a straight quote. It's not going to necessarily tell you what's intrinsic, what's premium. You can just figure it out. You could figure it out if you want to. You could look at the current price of the underlying stock. If it's above the strike price, well, that difference is the intrinsic value, and the rest of it's all premium. It's really that. It's just simple arithmetic. I'm only showing these terms, one, in case these terms are thrown at you, and two, it's important to your strategy to realize how much premium you are paying. You want to pay as small as premium as possible. You got to realize you're on the other end of the equation. The person selling you those options, there's some shareholder somewhere who has sold those options. It's in their best interest to get the highest premium possible, obviously. But you as the buyer, it's in your best interest to get the lowest premium possible. Because remember, those premiums those premiums are throwing money away, literally. So you're going to hope that you win on the option in order to overcome that. Now, considering all this, in my little nice example where Microsoft goes up one piddly dollar and you get a 200% dinger, aren't options a no-brainer? Why in the world, and if you look at that, if you just look at that data alone, most people would think, why in the world would you not trade options? Who in their right mind would do a $3,000 stock trade when you can do a $300 stock trade and make as much money? Right? Well, it's not a no-brainer, and here's why. Because options decay. And therein is the Achilles heel. Therein is the down point, the out point of options. Here's the deal in the Microsoft example. If Microsoft goes flat all the way to expiration date, you lose. As the option buyer, you are toast. And the reason is because that premium that you paid becomes worth less and less and less and less over time. And when it finally becomes expiration date, your contract is worth zero. Zero. And it's gone. The broker will literally delete it off of your portfolio. So whatever you paid for it is lost. So here's the difference. If you hold Microsoft straight shares, and this answers the question of why options aren't just a total no-brainer. It's because if you do a straight Microsoft trade, straight shares, if it goes flat like I just showed you, your loss is 0% after 30 days. If you do options, your loss is 100% after 30 days. So you see, that's quite a difference. I mean, 0% versus 100% loss. That's pretty significant. And that is why options are not necessarily a no-brainer. Therein is the downside. All right, before we get into how you get around that problem, let's look at contract types. There's 3 general types of puts and calls. There are monthly options, which expire the 3rd Friday of every given month. But lately, in the last few years, has also been very popular weekly options, which expire every Friday. Now, not all stocks have weekly options, but most of them do, at least the ones we have on our list. Now, that doesn't mean that they're only good on Monday and not good on Friday. They're good at any time. Like, for example, right now you could buy, say, the 2nd week of March or whatever if you want. But it's the expiration date is why they're called weekly. It's not that they're only good for a week. It's they expire in different weeks other than the 3rd Friday of the given month. And then there's leaps. Leaps are long-term options. They could last for many months or even years. We don't deal with leaps. We don't deal with those at all in either optionality or we don't even talk about them. I think that they're insane because you talk about a premium. Imagine paying for the right to buy a certain stock like 2 years from now. Can you imagine the kind of premium you'd have to pay for that? It's pretty hefty. But they do exist, but we don't deal with those. Only consider monthly and weekly options. The idea is to pay the smallest premiums possible. The more time to expiration, the higher the premium. Therefore, you want to always get as close to the expiration date as possible, and that's within reason. I mean, if it's going to expire tomorrow at the close, don't do it. That's too soon, too risky. But if you have a choice between buying something that expires in a month versus expires in a week, for heaven's sake, do the week, because you won't pay that much premium then, you see. Now, some people don't agree with me. Some people think they want a whole bunch of time in case the option goes bad. I say no, because remember, just look at the perspective from both sides of the contract. The seller of the contract wants as high as premium as possible, obviously. The buyer of the contract should therefore want the smallest possible premium. You are the buyer of the contract if you're trading options. You want to get the smallest possible premium. And the way you do that is you get close to the expiration date. Okay, how to trade. The mechanics. Again, keynote, you trade options just like you trade shares. You buy them and sell them later for a gain or loss. There is no difference whatsoever other than the rules given here. So a lot of new people get all confused, with the contracts, and I'm talking about premiums and strike prices and everything. It's just exactly like stocks. You have a broker. When they're enabled for options, you make a trade just like you would a stock. Do not pay attention to fancy systems that speak of spreads, hedging, and various tricks. You use the same strategies you have learned for stocks, period. Now, there's one exception to that I like to teach, which are the straddles, but that's sort of the exception and not the rule. The straddle is when you buy a put option and a call option on the same stock, right, both in the money. The idea being the stock spikes in one direction or another so heavily that the winning side way overcomes the losing side. And I've demonstrated that a couple of times in past sessions and in live Gars Gold Live. But I digress. That's just the only exception to what I just said right there. Okay, how to trade. Your brokerage account must be enabled for options. Most broker accounts do not automatically let you trade options. You have to request to trade options. And they give you all kinds of fancy terms like, well, there's different levels, level 1, level 2. All you got to know is you have to have the ability to buy and sell options. You don't want to sell level 3 and higher levels, or what they call naked sales, like naked puts, naked calls. Unless you have a huge account, not only do you not want to do that, but you can't, because they won't enable that anyway unless you have a really large account as far as naked calls and puts selling. And I don't even cover that in these sessions, so don't get confused by that. But you have to be enabled, and they're going to give you a form that you have to fill out and swear that you know what you're doing and that you're not a widow or an orphan and all that nonsense. You trade contracts, okay? One contract is 100 options. So when you put in an order, if you put in 1, that means you're buying 100 options. So that's one contract. Option quotes are displayed as option chains. Here's optionality. Here's exactly what I'm talking about. This here is an option chain. There's calls on this side, puts on this side. And by chain, it means it gives a whole bunch of different strike prices. See, this stock here, SD, is currently trading at $6.27. So you got different strike prices here. If I were trading this guy, I'd do the $6 call because it's in the money. You're thinking, yeah, but Gar, look at that. The $7 call is only 3 cents, 4 cents. Yeah, but it expires February 22nd. You're going to lose your ass because unless SD ramps all the way up to $7, that thing's going to expire worthless. And that is a hell of a big move to make any money. Yeah, it's cheap, but it's cheap for a reason. You're only paying a 4 cent premium, but that's because you're probably going to lose your money. All right. Anyhow, but on the pinkish reddish side is put options. Let's say I wanted to do a put option on this guy. I'd probably choose, well, you could choose the $6 put. The problem is it's kind of far out of the money because it's trading at $6.27. You'd probably have to, it has to drop at least 27 cents to really start ramping up. And that's kind of a tall order. So you might even want to go to the $7 put. I'm not saying you should do a put option on this. I'm just saying if you wanted to. Anyhow, that's an option chain. The price of one contract is the option price in the chain times 100. Remember, this quote here is for one option, not one contract. So in the case of this call option, this $6 call option, you'd probably buy it around 37 cents per option. That means a contract will cost you $37 because you multiply that times 100. Buying contracts is done with a buy to open order. Selling them is done with a sell to close order. The best way to demo that is the paper trader. You see this? Buy to open, sell to close. See, there's two other ones here. There's buy to close and sell to open. I got news for you. These two do nothing in optionality. Buy to close, sell to open. These are here, though, to make it emulate your real broker, because there is such a thing as buy to close, sell to open. But that's for a different day, different time. That's when you sell options against stock that you own. That's what that is for. But that feature does not exist in optionality. So buy to open, sell to close is all you care about. Essentially, it means buy and sell, which is for options. Now, here's important, and sometimes I take this for granted because I already know, but new people get all confused. There is no special ordering for put options. You buy put options the same. You don't confuse it with shorts or selling short. Even though they do involve a short position of sorts, in other words, your put option goes up if the stock goes down, just like you were short. There's no special handling. It's just another option contract, just like call options. Just buy to open, sell to close. No such thing as going short in options. It does not exist. All right, enough of that. Enough of the mechanics. Okay, option death traps. We already saw one, which is that decay. But there's a few others. This is probably the most important part of this session, because I guarantee you, if you just blindly pick the high scores in optionality, yeah, you're going to have losers, but they're going to be more winners than losers. I can literally guarantee you that. The reason I can say that without any hesitation is because our servers track the high score stocks, and it has like a 75% success in wins on those high-rated stocks for like months now, on both sides, both short and long. So I can guarantee you that those scores give you an edge. That's not how you're going to make money, believe it or not, because where you're going to make money is having the proper discipline. I can't emphasize that enough. I was chewing out Lico the other day saying, why are you letting these things expire worthless? You've got to bail at like minus 50%, worst case. Because if you start doing that, even though you might have a bunch of losers, all you need is one nice winner, and it makes up for all of those losses. And that's how you do well in this business. You're not going to win every trade. So for heaven's sake, don't let them go to zero. The biggest pitfall in options is potentially huge losses. I could tell you horror story after horror story about this. How about a week or so ago with Devin on the forum talking about doing massive call options on, Twitter or something. That's a suicide play, because that's potentially huge losses, and that's an options death trap. Okay, let's say you go all in for $10,000 on stocks. Let me show you why this is so bad for options. If you go, let's say $10,000 on stocks in a bear market sets in, you're all in, right? Let's say your $10,000 position goes minus 9%. It just gets pounded. Your net, you now have 9,100. You start with 10 grand, you now have 9,100. Okay, that's pretty bad, right? However, if you go all in on options for 10,000 and a bear market sets in, it goes to zero. And your loss is 100%, your net is zero. You see the problem. Let's go back here. Straight stock, you get pounded and crucified on your position. Maybe you're going to lose close to 10%, right? You've lost $1,000. You do the same dollar amount on options and you get the same disaster, you lose $10,000. That's a 10-to-1 difference in losses. So this is a death trap. Don't do it, and don't let it ever happen. So potentially huge losses is a trap. Time decay, we already covered that. Time decay is the fact that if you hold on to that option for too long, it's going to go down and down and down and down in value, and you're screwed. All right? You know, one of the problems I have in teaching people how to trade options is they're so inundated with the whole Wall Street pundit analyst jargon about long-term. Well, I'm in it for the long term. They're so inundated, and there's this mindset of buy and hold, you know. And even when people don't think they should buy and hold, they end up getting stuck in a stock position, and they end up holding it for months and months and months, hoping and hoping that it comes back. Well, that's all well and good, and maybe they eventually will come back. But with options, you can't do that. It doesn't work because it goes to zero, and the contract is void. So you can't hold an option for very long. Time is always against you when you buy and hold options. Time is your enemy in options trading. Okay, another pitfall is poor spreads and strike choices. What do I mean by that? Well, here's an example. This was an actual sample when I made this slideshow of the silver ETF. Okay, you're thinking, oh, silver ETF, that'd be a cool one to trade, wouldn't it, for options? Yeah, it would be, except for one problem. This spread here is 12.5%. By spread, I mean the bid and the ask. If, as a rule, unless the stock is super mega volume, as a rule, you can only buy at the ask and you can sell at the bid. So if you bought this option, you'd be down 12.5% right out of the gate. It's a loser. And unfortunately, folks, a vast amount of options on the market are like this, a vast number of them. And by the way, that's why we only have 100 and something options on optionality. There's 2,000 stocks, but only like 120 of them, I think, will show options. That's because I personally went through every single stock and picked out the ones that were decent. Had decent spreads and decent strike choices. In case anybody wants to know why there's only 100 or so. That spread right there is 16.7%. That's terrible. So if you entered that position, you'd be behind 16.7% without the stock moving a single penny. This is unacceptable. There's also no real choice. There's no real volume on this option either, so it might be kind of illiquid. There's a number of problems with these, but you won't find hardly any of these in optionality if there's options that show at all. And by the way, what I mean by that is, see, right now I have stocks and options enabled. If I click on a stock, you'll see nothing down here. See that? I actually got an email from a guy today who said, Gar, there's something wrong with your program. It's funny, it's always my program when it doesn't work, right? It's their program if it works. Anyhow, there's nothing wrong with your program. I'm not seeing any options in those scroll bars down there, in those boxes. That's because he keeps clicking on stocks. If you click on an option, they appear, lo and behold. And by the way, if you only want to see options, you click Show Only Options, and then they're all options. See that? Anyhow, I digress. So poor spreads and strike choices, another pitfall. Criticism from peers is a pitfall. Tell somebody you trade options who knows something about it, and they'll start laughing, saying, oh boy. They'll look at you like you're some sort of gambling addict. Seriously, options trading has a very bad reputation for some reason. It's very politically incorrect. You'll get stuff like, that's just gambling. Everyone I know who plays options is broke. Most options expire worthless, etc., etc., etc. Well, I got news for you. What's wrong? What's the bummer about these statements is that a lot of them are true. In other words, if you don't follow the rules and get your discipline in, these things are going to happen. You will just be gambling. You know, like the Devon thing of going all in on, on Facebook call options or whatever. That is gambling. And everyone I know who plays options is broke. Well, yeah, they're broke. If they do stupid things and let their contracts expire to zero, of course they're broke. So you see what I'm saying? These are true for too many people, unfortunately. So here's how you counter these horror stories. Here's how you get around these pitfalls. How about the potential huge losses? How do you get around that? Solutions. You maintain strict rules of trade allocations. God, I can't emphasize this enough. Maximum allocation should be 1/4 of your account size, and that's worst case. Preferably, ideally, it'd be 1/10 of your account. And you really know why that works. It's because if you're only trading 1/10 of your account on an options trade, if you do total boneheaded, knuckleheaded things and you let it go to zero, you've only lost 10% of your account. That's a lot, but it's not the end of the world. That's if you let it go to zero. If you let it go to 50%, which is what I would recommend as your worst case loss, then you've only lost 5%. So you live to trade another day. But you've got to maintain this. Now, here's the other thing I don't emphasize enough. This doesn't mean that you trade smaller and smaller. No, because there's the reverse of this is true as well. If you don't trade enough, that's also a mistake. It's the inconsistent trading allocations that kill people. So, example, your first option trade, you go 400. And it doesn't do very well. And oh my God, as painful it is, you have to bail at minus 35%. Ouch, right? You then do another 400, and the same thing happens. And so you bail. You're now down like $200 or $300. What do most people do on their third trade? They're scared, and they'll only trade 200. And guess what do you think's going to happen? That's right. The stock's going to soar, and they're going to make like 100% on that trade. You know what? They're still way down because they only traded 200. You see the problem. If they had traded their 400 like they should be, they would have overwhelmed those two losses, and they'd be even or even ahead. So you want to make the same allocations all the time and make them only a fraction of your account. Number 2, play only high probability wins. Don't play borderline gambling cases, all right? How do you know? Well, that's where optionality comes in. You see that? You see those scores? Those scores mean something. Like right here, SD is 87.5. That's its score. The highest possible score is 99. That's a pretty damn good score. Now, that doesn't guarantee a win, but we gave that out today because it was a high score, and a couple of guys are already up 20% on it. So that's a high probability trade. The scores mean if it's a high score, it means high probability. What's a high score? I don't know. I think 70 and above is a decent score. But you can maybe get in the high 60s. If you get down in the 50s and 40s, you're really playing with fire. You're gambling. Limit your losses to minus 50%. That's what I usually limit it at. But sometimes if I have low tolerance for losers, I'll get out even before then. Last Friday, I got out on a trade that was down only 15%, and I said, I don't like this. Sucks. So I just bailed, and I'm glad I did because the thing went way down after that. Oh. Above all, avoid the SFP syndrome. What is that? Well, I'm going to explain that. SFP syndrome. That is the sugar plum fairy syndrome. You know, this comes from the old poem, "'Twas the Night Before Christmas, and all through the house, not a creature was stirring, not even a mouse." That poem. I think as some people say that's how the modern Santa Claus was created. It was from that poem. But anyway, there's some line in there about the kids dreaming of Christmas with sugar plums dancing in their head. Sugar plum fairies or something like that. Let me show you here's the sugar plum fairy syndrome. You make a $200 trade, it goes very well. For one day, you make 250%. Woohoo! You're like super excited. And you think, wow, if my trade was $5,000, I could have made $15,000 in one day. So that's what you start thinking. That's the sugar plum fairy talking, folks. Because Murphy, as in Murphy's Law, has a permanent camp right next to the stock market. And if you dare follow that sugar plum fairy and go ahead and load up, remember your first trade was 200. Now you're thinking of going in for $5,000 because you could make a windfall, right? You make a whopping bet of 5,000 when your normal allocation is 200. What do you think happens? Stock plummets, $5,000 options fall to $720. You're destroyed. Yeah, this might sound outrageous to some of you, but don't think it's as crazy as it sounds because, you know, winning and money does funny things to people sometimes. And I guarantee you that sooner or later, you're going to fall for that sugar plum fairy thing to some extent. And you can get wiped out from it. I told you guys a story last week. I had a $500 account that I used to learn the best way to make money on options, and I traded it patiently and with discipline. Traded the $500 all the way up to $2,100 in a little more than 30 days. And what did I do? I ended up going almost all in as I kept buying more and more options because it kept going down, you know, the whole averaging down thing. And I wiped out all my account except 300 in like less than a week. All that work down the tubes. And that's because I gave in. I caved to the sugar plum fairy. So don't do it. If you give in to the sugar plum fairy syndrome, you will be ruined, period. Problem with decay. This is the biggest problem. The solution is you play very near or in the money. Why? Because if the stock makes a move, you're gonna gain really quickly. Or for that matter, if it makes a big move to the downside, you're gonna bail more quickly. Choose trades with a high chance of an immediate move. There's nothing more irritating than doing an option trade and the stock goes sideways. Because that is remember, time is your enemy. I'm stuck in one right now, XLF. It was going sideways for most of the day. Well, it's only one day. That's okay. When I say get in and out, I don't mean get in and get out in 10 minutes. I mean don't get in and sit there for 2 weeks because your option will decay heavily if you stay in that long. Stay in for a day or 2 or 3, typically. Play close to expiration and in the money for lower premiums. By close, I mean within a couple of weeks, 2 or 3 weeks max. That's my suggestion. Otherwise, you're paying too much premium. Some people don't like that. They like the comfort of knowing that if they get stuck, they can hold on to it for a while. But, you know, one thing you might not, if you feel that way, one thing you might not be considering is that's dead money. It's dead money. So in other words, if you're stuck and you're holding on to it, that means you can't trade it. It's dead, okay? So you don't want to be in for 2, 3 weeks on an option. That's nuts. You only want to be in for a few days. And so trade close. Now, when I say close, I don't mean you trade options on Thursday that expire on Friday. That's too close. That's cutting it too close for comfort. And that's borderline in gambling. But I'd say trading an option on Monday that expires Friday, that's all right, because you don't want to stay in that long anyway. Get out quickly. Don't stay in forever, because your whole option account will get devoured. By the way, the reason you buy in the money is because the option contract doesn't really go up that much until it gets in the money. So if this is your strike price here and this is the stock, if you bought it, let's say here, let's say this is the strike price you pay for, but the stock is right here, it has to make this spectacular move to even get in the money. And remember, time is not on your side. You don't want to have to give it that much time. That's why if you bought it here, you're way better off, because it just makes a tiny little move and your option goes way up. So that's pretty important. Okay, problem with bad spreads. The solution is you trade options that are super high volume stocks and ETFs. That is where optionality can really come in handy, because we only enable the ones for options that have decent spreads and pretty good volume. That's how you solve that problem. Here's an example. BAC, Bank of America. The average volume of Bank of America is something like 150 million shares a day. Million. The $11 strike price in this little example option champ showing traded 38,000 contracts. That's huge for an option. And you notice that the spread is 39-cent bid and 40-cent ask. That's only a penny difference. That's a nice spread. That's really what you want, that kind of thing. Plus, the heavy volume is good too, because you can get in and out really easy. Criticism from peers, which is the last pitfall. How do you get around that? You ignore them and don't make them right. For heaven's sake. Stick to sane allocations, trade only high chance, high volume options near or in the money, and don't fall for the sugar plum fairy syndrome. Also, consistent allocations. I should emphasize that even more. Don't go 300, 300, 300, 100. That'll kill you, because your 300 ones will lose and your $100 one will win. I can guarantee you that. And you'll still be behind. What options to trade? Answer, your choices should be identical to choosing stocks. Remember, all options have an underlying stock. There's no difference except for one. You trade only stocks that have very good option volume and option spreads, hence optionality. And that's why you want to use optionality. Don't just go willy-nilly trading options on any old stock. You'll get hammered that way. Optionality solves two major problems, which is it deals only in specific stocks that are best for options, hence good choices, good spreads, etc. And it monitors for the best possible outcomes, the highest probability trades, which handles the decay problem, right? Remember, if you hold on too long, you're screwed. That's why you need high probability outcomes. And I will now show you an example of one I did recently, of how I picked it. What example can we show? Oh, I'll show the one I did yesterday, which was a put option, which should make it interesting. Yeah, Microsoft put options. I only got 20% on it, which was kind of silly on my part, because it ended up gaining over 100% if I had stayed in. But you know, I'm not perfect. but I want to show you how and why I picked it. Unfortunately, we don't yet have a optionality replay. Wish I did. We will eventually, but not right now. But Microsoft, let's find it on the Microsoft is one of those options that trade heavily, right? And you get good spreads. Let's take a look at the chart on Microsoft. Yeah, the reason I have this, I'm showing the Williams indicator. The reason I'm showing that is because I like Microsoft a lot because of the Williams, and I'll show you what I'm talking about. First of all, for starters, Microsoft yesterday, remember the market started off negative and kept getting worse and worse and worse. That's called a downtrend. Worse and worse and worse means downtrend. Better and better and better means uptrend. That's the simplest, lamest way I could describe a market trend. A lot of people say, Gar, how do I know what the market trend is? Well, I just look at the stupid index. Is it going up or is it going down? I mean, it's really that simple in most cases. Now, if you're talking about predicting the overall trend, like for the next 4 or 5 days, that's a little different. But as far as what's going on right now in the market, it's really easy to see which way it's going. So it was clear to me yesterday that we were going down. And so I was just looking at put options, and Microsoft had a rating of 70. And by the way, for you, or 70-something, I think it was 76. By the way, for you new guys who don't know yet, you click short here to see the negative scores. You see, and they turn red, but that tells you its chance of downside. And Microsoft downside was 70-something, and the reason I liked it is because we just lost. Oh no, there's the chart. I like to look at a 15-minute chart to get a better feel for something. Here's why I liked it. Let's zoom in on where we were yesterday. Okay, before I'm even trading it, here's what it looks like on the 15-minute. Let me get a drawing pen here. Now, there's a technique I've been using of late, and it's very effective, and that's what I call the oversold, overbought curve, or better known as V-bottom or V-top. Notice here, Williams, whenever it's really low, that means oversold, right? That doesn't mean crap. But what it is significant is when it curves the other direction. Here's a good example right here. See, it's oversold there, right? But it's not until it curves to the upside is when you've got a trade. And sure enough, look at that. Microsoft flies upwards as soon as that curve sets in. Now, the reverse is true. As soon as it's overbought right there, when it starts heading south, that's when it crashes. You see that? Okay, now check it out. Look at that overbought condition. It's right smack at the top of that Williams scale, and they're buying here the day before, right? Now we're entering a downtrend. This is yesterday. This is the open of yesterday right here. This nice red bar. Look at that thing starting to crash, and we have a distinct curve, and the score is 76 right now. To confirm this is a good trade, I then looked at the daily, and why do I look at the dailies? I want to see if it has room to run. You know, you guys, I pound this in all the time. By room to run, I mean where is support and where is resistance? Support is right here. How do I know that? Because, folks, I've said it 100 times, that's where the stock bounces. It bounced there, it bounced there, and it bounced there. 3 times in the last month. I mean, come on. This is not rocket science. You just have to look at the chart. Well, here's where it is. Here's where it was when we traded it, it was right about here. That has a lot of room to fall. It's got almost $1 to fall down before it hits support. To me, this was a no-brainer put option. Market crashing, high volume stock with nice spreads. It's got room to fall. The Williams had a nice overbought curving indicator. What could go wrong, right? Well, of course something could go wrong, but it was a high probability trade. Remember, play only high probability trades, and this was a high probability trade, so it was a no-brainer for me. So let's take a look and see what happened. This was yesterday. Oh, I'm the wrong one. There we go. Look at that beautiful, beautiful put option. Entered about right here, right? I think I ended up getting out about right here, which was really a bummer because, yeah, it was 20% gain, and who wouldn't want a 20% trade, right? But look, it just keeps going and going. I think it was 100%, over 100% gain on that put option. Anyway, I wanted to share this with you. I wanted to show you how I think out loud on choosing these various picks. And that's all I have for tonight. Now, by the way, on Thursday, which will be the final session, I'm going to show, the whole session will be almost nothing but trade examples like I just showed you. So you guys can really, really get the feel of it and what I would go through in my thinking. Anyway, if people have questions or whatever, I will be happy to answer. Only the good questions, though. I won't answer the bad ones. No, I'm just kidding. I'll answer anything. Okay. Alan asked a pretty good question here, actually. He says, you sort of mentioned writing calls puts. As an options rookie, my broker will only allow me to write covered calls puts. Wrong side of the trade, right? Well, it's the wrong side if you want to trade options like I've been showing here. If you have to get your broker to enable you to the next level to trade options. Now, if you still won't let you, then get a new broker. Here's the deal. You have to claim that you know what you're doing. Because if you say, well, because when you fill out this form, they make you swear that you know what you're doing, and they want to let you know about all the risk. Remember, it's the common popular thinking that options are super risky and you're going to lose. The reason people think that is because a lot of people do lose, and the reason they lose is because they don't understand these discipline items that I've been covering. They don't get in and out quickly. They let them decay to zero. They do sugar plum fairy stuff and on and on and on. And they trade bad spreads. Like there's a bunch of mistakes you can make. So you have to swear you know what you're doing. Now, if you say, well, I don't really know what I'm doing, they won't do it. They won't give you, they don't want that liability. They don't want you to come back and sue them or whatever saying, you didn't tell me that I was going to lose. See? Yeah, there's a whole bunch of questions piling in here. Let me see if I can get to them. Oh, and by the way, selling calls and puts, that's called writing covered calls or writing covered puts. That's actually a really nice technique. The caveat there is that you have to have a really large account for that to be worth it. But I'm going to, it's fantastic for retirement type accounts, IRAs, because writing calls, for example, is super duper low risk. And you can make some pretty good money if you do it right. I'm going to have a whole product for that, by the way, this year sometime on managing IRAs with writing covered calls. I'm actually going to have products and scanners that give you the best covered calls to sell to people. And I'm going to go out on a limb and say that you can get 30% a year or more on your IRA if you follow these techniques with super low risk. How about them apples, huh? The reason I don't do it is because I don't have a huge account. I wish I did. But I would be writing covered calls all day long if I had a huge account, because it's like easy money. But that's a whole different subject that's not covered in these seminars here. Yvonne says, Gar, I tried to put in a buy midway between bid and ask, but sometimes if you really want the option, you'll need to pay the ask. Yeah, that's absolutely correct. You know, sometimes I almost laugh at some of these people, and I do it myself. I make this mistake too. Let's say the ask is 20 cents and the bid is 22 cents, right? Or let's say it's 21 cents. Ask is 20, the bid is 20, ask is 21. For some reason, people feel compelled to get that penny different, that penny bargain, so they'll put in a bid, they'll put in their order at the bid, which probably won't get filled. And they sit there and sit there and sit there, and then they never get filled and the stock takes off. Okay. Now, that's fine if you really don't like the price. But in that case, you should go lower than even that, right? But the point of that is, if you want to get into trade, why are you quibbling over 1 penny? I mean, for heaven's sake, just do the ask and get the trade filled, especially when there's not really much of a spread. My point is, if you want to trade the stock, if you agree on the current price, then trade it. Don't screw around trying to pinch a little penny out of it. I see too many people do that, and I see this comment almost every day on the forum. Gar, it looks like it's getting away. I never got filled, you know. And it's like, okay. And I'd understand, I'd understand it if they put in like say 5 cents below because they just think the thing is too high. Okay, that's fine. But if you're doing 1 penny below the ask and you're complaining that you're not being filled, that's your fault. Anyway, Lico asks, is there any way to freeze a demo chart to print it out and study what you presented? You talking like on the videos? Well, that's just a video problem. YouTube, I believe there's a button somewhere to halt the video. You're going to have somebody show you that, because that's not under my control. It's probably, I think there's some button you click to pause. Here's a question. If you buy and sell an option in the same day, is that considered a day trade? Yeah, I think it is, unfortunately. But you know what? I don't never have a problem with that, because I don't do enough trades to remember, you can do 3 day trades a week and still not be flagged as a pattern day trader. And I find that I don't do 3 day trades a week with options. I just don't. I mean, because a lot of times I'll hold at least overnight for half of them. The other half, I don't do that many. I don't do a whole lot of trades. So it's pretty easy to get around that. Like one of my favorite trading methods, whether it's stocks or options, is trade at the end of the day. You know, in hopes that the market will spike one way or the other in the morning. I love that for some reason, and in fact, that's the only way to make money in a sideways market, because it seems the only time we get any real movement is in the first 30 minutes. But anyway, that eliminates the day trade problem right there. But just make sure you don't buy and sell the same day for 3 times in a week. That's all you have to watch out for if you're worried about that day trading thing. Someone asked, do you have a suggestions for a decent discount broker like Option House or Options Express? You know, my problem with, I'm not the right guy to ask. The problem with that is that I've only used 2 brokers in my entire life for options trading. so I don't have that much experience. However, I've been told that Interactive Brokers is pretty good for cheap commissions. I personally use Options Express. They are decent, but not the best in terms of commission rates. I like Options Express because it seems that their fills are really, really fast. I've never had a problem getting filled really quickly on Options Express. But their commissions are kind of medium. You know, they're not great. They're not terrible. Somebody says there is stocks. Is there a way that I could obtain scores for those stocks if I add them to optionality, or is that only for stocks that have already been entered? There's no such thing as adding stocks to any of these products if they're not already there. We have a master list, and that master list is scanned on our servers. You can't add one because it doesn't know that it exists. The reason we have a master list is because our data feed's limited to 2,000 symbols. If you guys want to pay us a whole bunch of money, more than you already have, then we'll be happy to get a better data feed, which is 10 grand a month, by the way. That's right, 10,000 a month to be able to do the whole entire stock market. It's absolutely outrageous. But no, you can't add anything because of the way it works. I don't see why you'd need to, you know. I mean, there's some stocks that should be added right now. To be honest with you, we're way overdue to overhaul the master list. It's been months and months and months since I've done that, and it's a lot of work because a lot of things have to be updated. You know, market replay, the retrospect backtester, midnight review, everything has to be updated with the new list. But it's overdue. We need to do that soon, and there'll be stocks there that ought to be there. You know, for example, Twitter's not in there because it's too new, that kind of thing. But for the most part, when the master list is updated, there's really no reason why you'd have to have an extra stock in there. Because, I mean, 2,000 plus stocks, I don't know, maybe it's just me, but that seems like an awful lot to choose from. So, anyhow, let's see, another question here. Let me see if I can read this one here. It's kind of confusing. It says, in the money calls and puts usually have great delta. Delta, by the way, means how well the stock tracks with the stock, I believe. I hear a lot of online emphasis being put on implied volatility, and broker platforms tend to let you view it on the spread. Question is, how important is any of the implied volatility? I don't know. I mean, implied volatility, by the way, is how they price the premiums. I mean, it's part of the equation. I don't really fully understand the equation. They call it something like black skulls, but the volatility has a lot to do with how they price those premiums. Because you'll notice this, if you go to a very high volatile stock, you'll see the premiums are sky high. And super low volatility stocks, you know, that tend to go sideways for long periods of time are very low premiums. And so the implied volatility is what sets the premium. So my point is, you don't really need to know what the quote-unquote implied volatility is, because you can just look and see what the premium is. And that tells you all you need to know. I mean, are you paying too high of a premium or not? I mean, because that is, in fact, the implied volatility in a sense. Somebody says pattern day trader isn't a margin account only, correct? Yes, that is correct. Pattern day trading only applies to margin accounts. However, the one thing that very few understand, and I mean particularly newcomers, is that if you don't have a margin account, you don't get instant credit when you sell something. See, therein is the problem. What actually happens with the pattern day trading rule is that you lose margin privileges if you're a pattern day trader and your account's not high enough. That's what happens. So a lot of people think they're restricted from trading. Not really. What happens is let's say you have a cash account. Let's say you're not even a day trader. If you have a cash account, not margin, if you sell a stock, it takes 3 days for you to be able to use that money again. Because there's some weird thing in the stock market chain that takes 3 days for your transaction to clear. You know, it's like banks telling you it takes 3 days to clear a check, which is bogus. They just do that so they can float your money. But I believe the stock market probably does the same thing. But anyway, it's still 3 days. If you have a margin account, your broker is literally giving you credit for those 3 days so you can trade it immediately. You see? Therefore, if you're a pattern day trader and you do more than, if you're a pattern day trader and you don't have 25,000 in your account, you lose the margin, which means you have to wait 3 days to realize your transaction. That's really the pitfall. Now, I don't know how that works with options. I think it's probably the same, but I've never been flagged as a pattern day trader with options yet, so I don't know what happens. Maybe somebody here has. Leon again says, I mean freeze the chart during webinar replay. But Leon, the webinar replay is a video, and it's on YouTube. And I have no control over how you operate YouTube. I believe in the video playback there is a pause button somewhere. I think you have to move the mouse around in the bottom of the video for it to show up. Otherwise it's invisible. Have somebody who runs computers show you how to do that. It's beyond my control is my point. I didn't make YouTube. Somebody asks here, says, when will you have the add-on for trading specific stock options you were talking about? Oh, you're talking about this feature that I'm working on where it tells you what indicators are best for an individual stock. I've been working on that as we speak, and I plan on demoing that somewhat on Thursday night. It won't be available probably till after the weekend. But it's a lot of work, but it's very slick. It'll show you. You see, the whole idea of it is you have a list of favorite stocks. Okay. This new feature will tell you what indicators work best for that stock. It'll say like, well, you know, remember that little curve I was showing you, like that Williams curve? That's an example of one that it'll tell you. It'll say Williams curve works, you know, 78% of the time. That sort of thing. The reason why that is so slick is because everyone has their favorite stock. I do. I have a list of like 12 of stocks I like to track. And a couple of months ago, I'm thinking, you know, if I just knew what kind of indicator to look for, what kind of setup to look for each one of these guys, I could make a killing. And so I went ahead and tried to figure it out, and sure enough, they all have different favorite indicators. They all work differently with different indicators. Some of them work great on oversold bounces. Some of them work great on big buy volume, that sort of thing. And that'll really give you an edge on your watch list. But, yeah, I'll demo some of that on Thursday, and then it'll probably be available next week. Somebody here is saying that for options, your delayed time for a transaction to be cleared is 24 hours. See, I don't know those things. Maybe some of you out there might know more about it than I do. The reason I'm saying that is because I've never had an issue with options. That money's always been available to me instantly as soon as I close a position. All right. Any other questions, comments, horror stories? No horror stories. Only I can tell the horror stories. If not, I'm going to shut down the shop here. I want to thank everybody for attending, and it's been fun. And happy trading, and let's get some winners the next couple of days, all right? Who knows what the market's going to do, but you just have to observe and go with whatever direction. All right?